Good afternoon, ladies and gentlemen. Welcome at the EFG Financial Products Day. It's the first time I speak here, so you will apologize if some of you actually don't understand everything I'm going to say. I'm going to talk about some smart asset allocation. The reason why we actually picked that topic is very simple. Around 5 years ago, I happened to start to do something that most of us already did or should do very urgently at some point in their life, is to handle their pension plan. So I grew up in equity. I'm a pure equity guy. I started with Tech DAX, Nemax, Eurostox, S&P, and everything. And when I started to handle my pension plan, I really had to start focusing on the asset allocation. So for the first time, I had to pick bonds, I had to pick ETFs, I had to choose the hedge funds that I wanted to invest in, and so on. So my background, as I was introduced, is 10 years in trading, so I'm extremely risk-oriented. And when I looked at all these asset class, my first question was, okay, which risk am I really taking? And by investigating into each time what I was really investing in, I was a bit scared, I must say, because I realized that sometimes the returns that I was extracting for something which was supposed to be a core component of my portfolio was definitely not suitable with my return expectation. So what I decided is actually to not manage my pension plan based on my yield expectation. I decided actually to manage my pension plan based on my risk expectation. I know which risk I want to take, and on the back of it, I'm going to try to have as much return as possible based on this risk. So I started to review the possibilities to replace bonds, to replace cash, to replace ETF, shares, and everything. And in 2010, at EFG FP, we actually tried to push as much as possible some product replacement ideas. We fully respect the fact that each investor has his own view. So my purpose today is absolutely not to pitch you what my view is for the market. It might be the opposite of yours. It might be exactly yours. The point is really here to say, what are the risks that you take right now with your cash, bond, equity allocation, and what are the products you could be investing in order to improve your returns? So as I said, the first point number one is actually to focus on the risk that we take with all of the portfolio components. So let's start with the cash. Well, in 2007, I was back in London, and people started to talk about a bank I never heard about, which was Northern Rock. And for the first time, I realized that actually a bank could go bust, and together with it, actually all the assets and the cash we had with it. So that was quite a shocker, I must admit. But nonetheless, it's a risk that we still take, the fact that if your bank depository actually goes bust, you lose your cash beyond the state-guaranteed amount, which is around 100,000 Swiss francs. On top of that, the cash has a main problem right now, which is maybe it's safe, or it's as safe as it can get, but you enjoy a very, very low yield. What about the bonds? Then the bonds have two main risks, of course. The first one is actually the duration risk. In an extremely low yield environment, in low interest rate, buying a 3-year, 5-year, 10-year bond is actually a bit risky. Just to give you an example, 5 months ago I tried to finance a flat, and the mortgage in 6 months, the rate moved from 3.5 to 4.5 in the last 6 months. So whoever bought some bonds in September did a fairly bad deal. So the point is, we are still in a very low yield environment, and the duration risk is a major one we have to consider. The second risk, of course, is the risk of your issuer going bankrupt. And especially because we focus on yield, we tend to actually pick ratings which are not AAA anymore. We have to go down to AA, single A, and very often BBB, which is the lowest investment grade level. And for these, we will see in a second that the yield are absolutely not satisfying. So once again, the inconvenience of the current bond environment, of course, is a very low yield. Now, what are the risks inherent to equities? I'm not going to talk about stocks as such, because the risks are obvious in terms of micro allocation and so on. I'm going to focus on ETFs and funds. So the ETF, for instance, okay, of course, you have 100% of the downside should the market go down. You have as well the same volatility as any index market, but you have two main problems in the ETF. The fact that your dividend structure is very, very often not optimized at all. Very often you end up having around 70% of the dividends that the index would pay, and on top of that, they charge you a management fee, which on average is around 40, 50 bips, depending on which ETF we're talking about. So the presentation is about introducing some possible alternatives to each of these asset class. So let's start with the cash. So let's assume that we are an investor with some very significant cash in the portfolio. I'm not suggesting to move all the cash, but I'm suggesting to move part of that cash into an alternative, which is called an express certificate. It's also described as auto-callable. The structure, we will have some examples demonstrating how it works exactly for those of you who are not familiar with Payoff auto-callable. The structure is something which actually has some recurrent observation. In this case, it's quarterly. On a quarterly basis, we will look at where the underlier is. In this case, it's going to be Euro stocks. And if it's above a certain threshold, in this case, it's going to be 90%, then you will get your cash back. And in any case, even if Euro stocks has gone down and it's down more than 10%, you will get a guaranteed coupon on a quarterly basis. We designed that product with what we call a 40% strike, which means that you will start losing money only if the market goes below 40% and from 40%. It's not a barrier product. All the products that we'll talk to you about today, they are non-barrier products. Personally, I don't like the barrier components because I think you have actually the proper risk of digital to lose, like in one shot, a very big amount of your notional. In this context here, we're talking about cash replacement, so we'll focus on safety. And the example will speak by themselves, and you will see to which extent these products can actually yield much higher while still providing you a very comfortable risk return. These products, for instance, even if it's an equity-linked product, some of you could think, okay, he's pitching us an equity-linked product for a cash replacement, so it's not very intuitive. This product would have lost money only in 0.3% of the time over the last 25 years. In any other case, it would have yielded 3.2% per annum. And the worst case scenario over the last 25 years would have been a final redemption value of 95.5%. So the product we're pitching you today as a cash replacement has the worst case scenario, had a worst case scenario over the last 25 years of 95.5%. So it's a very, very safe investment. And in 99.7% of the case, you had 100% of your cash back plus a much higher yield. So, as we discussed, you have two problems with the cash components. You have the fact that right now, if you have cash, sometimes you don't even have any interest on it, or they pay you something like 1 month LIBOR minus 50 bps, something like that. So we took the assumptions which we found reasonable. 1 month Euribor minus 50 bps is what you get on your cash allocation. Our product is yielding 3.2% per annum. It's organized in 80 bps installments on a quarterly basis. Guaranteed coupon. The risk associated with the auto calls are actually the risk of bankruptcy of your bank. That's why we made this product cozy. Cozy, most of you must have heard about it by now, is actually, it stands for collateral, which means that we pledge some collateral in cash, in bonds, and in safe equities to the SIX. And the SIX is monitoring the amount that we need to put as collateral. We are not the one deciding. We're not the one putting on based on our own calculations. The SIX calculate how much we need, they monitor it, and they ask us for the money, for the bonds, and everything for the collateral. So here, the risk of bankruptcy is reduced to its minimum because we have a very diversified portfolio of cash and bonds composing the collateral. So now the yield. The yield, of course, is a major problem currently in cash. So we have, on average, around 25–30% of the portfolios are currently still in cash. But it's yield absolutely nothing, which, when you do the average performance of your portfolio, it's already a third which is producing nothing. Now, our product has a very significant yield pickup of like 3.2% per annum. The examples that I'm going to show you about, that I'm going to show you in a second, will really explain way more than words how the 40% strike is providing you safety. Let's take the first example, very simple. Let's take the example of, in 3 months from today, we actually observe where Eurostoxx is. If it's above 90%, we will give you your coupon, which we would pay you in any case of 80 bips. We also pay you your 100% back. So in 3 months from today, you get your cash back, and you have already an 80 bips return on something which was in the past yielding almost nothing, which was your cash allocation. Example number 2. Let's assume that that product, you've been unlucky, was never auto-called over the 3 years of maturity, which is the length of the product. And then we are in 3 years from today, and the market, of course, is below 90%, otherwise it would have been auto-called. But nonetheless, you're above 40%. Now what happens? Well, In all the Q1, Q2, Q3 until Q12, you would have received an 80 bips coupon, guaranteed, irrelevant what the market does. And now at maturity, because the market is above 40, we pay you 100 back. So even if the market, in 3 years from today, has lost 50% of its value, you still have 100% of your cash back, plus a 3.2% return per annum. Now, let's look at the case where, how does it work in scenario number 3, where actually the market is below 40%. Then, for those of you who actually know the barrier products, if you have a barrier and the barrier is triggered, then you lose from 100. This product is different. If at maturity you are below the strike, you lose only from the strike level, which means that in this case, if the market ends up being at 35%, because your strike is at 40, your redemption is, instead of being 100, will be still a very high proportion. It's going to be 87.5% of your initially invested capital. Still keeping in mind that you will have collected around 3.2% per annum, which means that if you aggregate all your payoffs in 3 years from now, you have put 100 today, you still get 97.1% of your invested capital. Now we have to keep in mind, we're talking about a scenario here where the market has dropped 2/3 of its value. By then, the risk of the depository bank going bust is extremely real. The risk of your cash yielding absolutely nothing is extremely, extremely likely. So here we're talking about a very, very safe product. And the only case, and it happens only, once again, in 0.3% of the case over the last 25 years, in this scenario, you still have a fantastic value retention. So a concrete example would be to say, fine, so what happened if the guy who actually invested in that product was the most unlikely guy on earth and struck that product at the peak of the Eurostoxx 50 in 2007? Then in this case, we say, okay, fine. The 40% correspond to pretty much as low as Eurostoxx went. But in the meantime, and even then, we didn't go much below 40%, and we're talking about Lehman Brothers going bust and everything that followed, of course. And after that, you had the recovery. The payoff of this product, in the scenario of you picking exactly the top of the market and striking that product on that day, the payoff would have been nonetheless 100% at maturity, plus 12 coupon, which means 9.6% in total. So over 3 years, for something which is supposed to be your cash allocation, you would have yielded 9.6%. Okay, so that was it for the cash product. Let's focus on bonds. This graph shows you, as of last week, the swap rate 3-year, the AAA rated bond 3-year as well. Sorry, I'm looking at only that part. This is the whole curve, the 3-year only, and the BBB rated bond. In September, end of August to be precise, we actually end up looking carefully at what the credit risks were and how much they were yielding. And we realized that the BBB rated bond, which is something that almost no investor would like to have in his portfolio in terms of quantity, you want to have some to increase your yield, which is not something you want to crowd your portfolio with. Then back in end of August, it was yielding really, really not much. And even today, actually, when you think about it, you have a swap rate around 1.9, you have a AAA rated yielding 2.25, I'm talking the 3-year, and your BBB rated yields only around 3.1 or 3.2%. So we have to keep in mind that BBB rated bond is extremely low quality, not as bad as double B and single B, and of course, but triple B is really something that people tend to avoid in their investment. So our idea is actually in this case to use a very similar payoff to the one we used before for the cash. The idea here, we pick the 3-year. In this case, we will observe if the Eurostoxx is simply above its current value in 1 year, in 2 years, and in 3 years. Then, in any case, irrelevant what Eurostoxx does, we will pay you 4.5% per annum, guaranteed. Here we decided to use actually a 50% strike and not 40 anymore, because BBB has an adjusted risk much higher than cash. On the back of it, we had to reflect it in the product, which is as well slightly more risky, but 40% or 50% is still extremely limited. My feeling is, to reflect the proper risks that you take with a BBB rated bond, you will need to put a strike at 60, 65, meaning that the coupon that we are about to offer you is lower than the one that you could expect at a very equivalent risk. So here we are pitching a replacement product for BBB rated bond with a product which I consider is really, really much safer and yielding much more. Now, a lot of text in there. Let's focus point by point. We said that the bond risk have three main risks. The number one is actually the duration risk. And this is exactly where the autocall payoff actually is very, very interesting. An autocall is actually linked to the performance of your underlier, which is in this case Eurostoxx 50. Now, duration means what? Interest rate going up. You are long bonds, you lose money, mark to market, fairly painful. As much as it was friendly in 2010, could be painful in 2011, 2012. So the point here is to have a product which will actually benefit if the interest rate goes up, or benefit from a context in which the interest rate goes up. The way we think is like anybody else. If interest rate goes up, it means that the equity will be doing better, and if the economy is doing better, and if the economy is doing better, it means simply that the equity market will have performed fairly well. On the back of it, in 1 year from now, you have a very high likelihood to have been auto-called to get your 100% cash back, plus your 4.5% coupon, which is the one we offer you in this product. The issuer's default risk. We made this product cozy as well. So this product is on Eurostoxx 50, which is a widely diversified index. Geographically, of course, it's still Euroland, but in terms of sectors and so on, it's diversified. A BBB rated bond, by definition, you run a micro risk of the single company going bust. A BBB rated bond, to give you a feeling, corresponds to a company which trades at a volatility of around 35 to 40. It's very high. It's not as high as emerging market vaults, of course, but it's very high for developed markets. Eurostoxx 50 trade at 20-25. So we're replacing a single underlier by a diversified underlier, a 35 vol by a 25 vol, a 3.2% coupon by a 4.5% coupon, a duration risk by no duration risk. Let's go through some examples. So the graphs are exactly the same as we did for the cash replacement, except that here, the autocall level is at 100. In 1 year, if the market, Eurostoxx 50 in this case, is above its current level, you get autocalled, you get your cash back. Irrelevant what it means, maybe the interest rate will have doubled by then happy days. You will get your cash back, you can buy bonds if you consider at that point that bonds are actually yielding more. You will be able to do so. If you buy bonds today, in 1 year from now, the last thing you will want to do is to cash in your mark-to-market loss if interest rates went up. So in this context, in 1 year, let's assume that Eurostoxx 50 is at 103% of its initial value. We will reimburse you your 100. We will also give you a 4.5% coupon, which means that your yield, of course, will be 4.5 over the investment. Here, let's consider that at the end of year 1, you are not auto-called, end of year 2, you are not auto-called, and at the end of year 3, we are now at maturity. Now, what is the scenario? Whether you are below the strike or above the strike. If you are above the strike, exactly the same thing as before, you get 100% of your notional back, and in year 1, in year 2, and in year 3, you enjoy the guaranteed coupon of 4.5%. So, if at maturity the market is down 40% from today, FYI, in 2008, most of you must have had some bonds in the portfolio, a BBB rated bonds, they were trading at around 50% of par. So the mark-to-market was also very painful. Here, we're talking about equity market going down 40% in 3 years from today, and nonetheless, you have 100% back in a fully collateralized product, so you have no issue or risk from that perspective, and you're yielding on top of that 4.5%. Now, how bad can it get? Well, of course, the market can drop more than 50%. Then in this context, we assume that Eurostoxx is at 45% of its value of today, so it's more than halved, fairly bearish scenario. Then, at maturity, the notional that will reimburse you will be a bit less than the 100%, is going to be, in this case, 90%, okay? Which compared to the mark-to-market or even your BBB bond issue actually going bust, is still giving you 90% back. You don't have, like in the Lehman bankruptcy case, you don't have to wait for the litigation amounts and so on. You have your 90% back. But in the meantime, of course, you will have enjoyed 3 coupons of 4.5, which in this case means that in 3 years from now, your investment will give you 103.5 in total for 100 today. But we are talking about an investment environment where the market was more than divided by 2. Same thing, what did it mean, for instance, for somebody who invested in that product back in 2007 at the top of the market? then this guy, for instance, would have received his money back in 2010, 100%, he would have enjoyed as well 4.5% of yearly coupon guaranteed. So in total, he would have enjoyed that payoff here. So 113.5%. It's very important to keep in mind that we pitch here only strike-related products and no barrier. We want the investors to realize that we consider the downside risk as our #1 priority, and we simply want to increase the return by taking the exact same amount of risk, and even, if possible, less. And I insist, this product, according to me, is really much safer than multiple bonds, and as a matter of fact, this was the blockbuster at EFGFP in 2010. Alternative to equities. Okay. Now, equities, as I said, is where I grew up. So I thought investing in equity is something I could do decently well. Still to be proven sometimes, but nonetheless. Here, the interesting part is really to concern, I totally respect the fact some of you might be bullish, some of you may be bearish, and so on. I'm just saying, if you have some ETFs in your portfolio, if these ETFs are done by issuers which are actually not providing you the best dividend return or not the optimized investment and so on, then you really have to consider alternatives to these ETFs. In this context, we took one of the most traded ETF on Eurostoxx 50, which is the EUN2, the iShares Eurostoxx 50. As you can see, and it's quite counterintuitive, the EUN2 is actually underperforming the index. The index is supposed to pay you a higher yield, so theoretically you would expect the performance to be the other way around. Now, what are the equity replacement products? If you are an ETF investor and you're currently invested in iShares, we have 3 products for you. The #1 is actually an auto-callable, which is a very similar payoff to the one we saw before, but you will see the risk profile is way more aggressive. Why? Because you have, in this case, we consider that you accept 100% of the downside, which is a case where you have an ETF in your portfolio. By default, you accept 100% of downside in the equity market. Now, these replacement products, #1, would be yielding 16% per annum. And you don't need the market to be up 10% for that. You simply need the market to be up 1 bip, 0.01%. And we pay you 16% per annum. If on any year from today, year 1, year 2, or 3, we will pay you 16% per annum. You will see in some examples that these products, if in 1 year from today we are above 100, and if in 2 years from today we are also below 100, but in 3 years from today we have recovered and the market is at 101% of today's value, this product will give you 148% back. And you will say, yeah, but what kind of downside do I take? You would take the exact same downside as holding an ETF, which is 100%. So product replacement #2 is an outperformance. Some of you might be familiar with the outperformance. It's simply the fact that we say, okay, you have 100% of the downside, and we increase your upside participation. Especially in January, in any January month, all investors are actually shaping their portfolio, looking for immediate participation products. The idea #3 is actually the one product among all that we are presenting today, which is not exactly what we discussed about. In this case, we consider that to give you the same upside, we will actually give you a safer profile on the downside. So let's start with the product #1. The product #1 is a Cozy Express certificate. Something to keep an eye on is the fact that an iShare, so an ETF, the assets are segregated. But did you open already the term sheet of an ETF? If you go through the term sheet of an ETF, you will see that it explicitly mentions the fact that you have a risk, you are at risk of the depository bank. Why is that? An ETF which is actually replicating Eurostoxx 50, whether they tell you they buy the shares and they replicate it and so on. But what they are entitled to do is enter into swap transactions, trading futures, holding cash. If they hold cash, they hold it in a depository bank, and that cash is equally at risk as your cash, point #1, if the bank happens to go bust. And to give you a scary example, iShares, Eurostoxx 50, changed the depository bank, which is Ireland-based. Until July 2010, they were using Bank of Ireland, and they changed. So very important for us is to say ETF is supposed to be segregated asset. For us, we consider safety as criteria number one. On the back of it, we pitch once again a cozy product. What is the yield of an ETF? If you take the example of Eurostoxx, which is an index yielding more or less 4% per annum, you have a 15% withholding tax applying to the ETF company. So they will tell you, we receive only 85. So then they will give you only 85% of this dividend, of the Eurostoxx dividend. And then you will be taxed once again, 50% at least, on that amount. So more or less, depending where you are in Europe, more or less you will get around 70% of what the index would actually yield. Our product is actually using the full dividend, the full repo rate of the index itself, and that's how we can actually reach this kind of payoff. The payoff works as follows. At the end of year one, we observe if the market is above 100. If the market is above 100, but remotely, let's say, once again, 1 bp, 5%, 10%, irrelevant. We pay you 116%, 16% back. If the market is at 120% at the end of year one, then for this year only, we'll give you 16%. So you have a very small risk of underperforming the market if we are in a proper outperformance market, bull market. Now let's assume that the market actually goes down this year and that next year you are above 100 of today. So in 2 years from today, you are above 100. Then in this case, we will pay you twice 16. So we'll pay you 132. So if in 2 years from today, the market is at 101 or 102, we will pay you 132. The risk that you take is still the same. It's still 100% of the downside, exactly like when you own your ETF. But the payoff is much more appealing because you really enjoy a very significant pickup. And in year 2 and year 3 even, if the market is actually performing more than the 16% per annum, we give you the full upside on top anyway. My point is, if at the end of year 2, if the market is at 140, we are not giving you 132, we give you 140. So literally, at the end of year 2, in year 2 and year 3, you have exactly the same upside. You have the maximum between 16% per annum or full upside if the market is absolutely exploding. Now, ETF holding ID replacement number 2. This one is an outperformance. So what do we do with that? So we have once again, we assume that you hold the ETF, 100% of the downside. But in this case, because we're not an ETF house, they don't pay you any dividend, we actually invest directly in the Eurostoxx 50, we enjoy more dividend, the repo rate, and so on. With that dividend, we actually turn it into calls, which will increase your participation on the upside. So for 100% of the downside, this product here has 1.5 years only. Over 1.5 years, you will enjoy a participation to the Eurostoxx of 170%. You will outperform on the upside by 70%. And you have absolutely no cap. It's simply by optimizing. If you accept 100% of the downside, the key question is what do you get for that downside? With an ETF, you have 2.7 or 2.8% yield and 100% of the upside. If you accept the fact that you give up that small 2.8% per annum, which is not something that you are very interested in when you are an equity investor, you are playing the 10, the 15, the 20%, you have to consider this option. It gives you 170% of upside participation. Here, we actually made some example. Let's assume that the Eurostoxx 50 is up 20% at maturity in 1.5 years. Then, here, our outperformance will have a final value of 134%. 20% over 1.5 years, okay, it's around 12.5% per annum. It's a good equity market, but when you consider the free cash environment we are in, it's a fairly likely scenario as well. Now the question is like, do you want to have 124% via your ETF, accepting 100% of the downside, which is both composed of 100% upside participation plus the dividend, or do you want to swap and choose the outperformance certificate, which is yielding 170%? The key point here is like, this simulation of 20% over 1.5 years is a normal environment, but don't forget the environment we are in. The cash is literally on the floor. It costs absolutely nothing. Fantastically inflationary market conditions. So if people are bullish, the equity market can really have some great participation. So in this context, I would personally accept to give up the 2.8% of dividend per annum. If I am after 2.8% of dividend, I'd rather buy bonds. In this case, at least, I know what I am after. But when you invest in equity market, you have to go mainly after the market participation. Therefore, turn these dividends into market participation. Okay, the last product is an Airbag Certificate. In this case, it's slightly different. Before, we're pitching products where you had 100% of the downside, and you are actually turning the dividend into more upside. Here it's different. We assume that you get exactly the same upside, which is 100%, but we turn the dividend into a market protection. In this context, your downside, 1.5-year investment, once again, your downside would start only from 79. So which means that if the market goes down by 21%, you're not impacted. And it's only at 0 that you have the same payoff. My point is, in any bear market scenario, you will do much better. So it's also very interesting to focus on, okay, turning investment into less risk. It's also something to consider. And last year, we actually were pitching a product which was a 2.5 or 3.5 year, I can't recall. It was actually offering you 100% of upside participation, and your risk was only from 50 downwards, which means that here, in that payoff, instead of 79, you put it at 50. So you had literally 100% of upside, and your downside only started if the market was halved. And starting from it, it was not a digital where you lost 50. It was starting at 50. So it's very important to keep the airbag in mind when you are looking for equity participation products with a safer downside. Right now, the main problem is if you have the capital protected product, and that's what we'll talk about in a second, the main thing is you need to put a lot of your capital on the table. You can't have, of course, 100% capital guaranteed. 95 doesn't really fly neither. You have to go for 90%. 90% is already a lot of cash on the table. Your break-even is really going up big time because very often you have 90% of capital guaranteed for something which is supposed to have 100% participation. So you need to have an equity market performance of 10% for you to be simply break-even. Sorry. So the point here is to say, what about, instead of going for a CPU, what about going for an airbag with a very low strike, as low as possible, simply to match? Now, one word regarding correlation. I was talking a second ago about capital guaranteed notes. When people think about correlations, they say, ooh, risky. It's true. If you pick 3 names, like this basket here, where the average correlation is around 50, it's true it's a bit risky. This is the most traded basket in Switzerland, Nestlé Roche Novartis. Here, I'm going to talk about Eurostoxx S&P SMI. The average correlation is around 85. The reason why I'm going to talk about correlations right now is simply to show you something very basic. Just by going for a basket which is highly correlated, you can significantly improve your upside participation. Economically, it's unlikely that if the S&P does well, it's unlikely to see the SMI go soar or Eurostoxx go soar. Very likely you will have a very high, because it speaks by itself, these are realized correlation, Bloomberg data, objective data, 85% market correlation. So the point is simply to say, okay, instead of going for a good old capital guaranteed structure on Eurostoxx, what if I use a basket composed of 3 or 4 indices? And I can use a worst of in that context because the realized correlation is around 85% in that basket. So at the end of the day, I'm really turning correlation into a plus for me because all in all, the economic context is still the same, S&P, SMI. I'm not talking about China, I'm not talking about Brazil, nor Russia, just talking about the 3 most developed regions in the world. And the last one is actually including Nikkei, of course. Now, the participation, if you focus on your Eurostoxx 50, and if you consider, I think it's 95? Yeah, 95% capital guaranteed, the participation on Eurostoxx would be only 75%. If you take a 1.5-year CPU, 95% capital guaranteed, your participation to Eurostoxx would be only 75. Not fantastic. What I would do instead I would use the correlation products, where the basket is composed of Eurostoxx, S&P, and SMI. No Brazil, no China, nothing. Just very safe investments, 85% realized correlation. And in that context, your correlation would actually, your participation would move from 75 to 115. Now we're talking. 95% capital guaranteed, 115% participation to the worst of these three highly correlated underliers. And now, if you add to that another one which is slightly less correlated, but is still around 80%, less correlated to the first three, let's add to that Nikkei, then the participation that you can reach in that case is 125%. So simply by picking an underlier which is slightly different, moving from single Eurostoxx to Eurostoxx S&P SMI, you move from 75 to 115. If you add to that Nikkei, you move to 125 upside participation. So all in all, I really invite you, especially in the context of January, February, where you investors are after participation product and safety. If you are after CPU with a high capital protection level like 1995, really favor a worst off of highly correlated underliers. This is really paying off in terms of overall numbers. Thank you very much.
Well, Mr. Besnard, thank you for your trading insights. Jami, thank you for your trading insights and your passionate presentation. We just have some minutes for a short Q&A. So if there is any questions, feel free. Well, please, just short question, short answer, because we want to stay in time. Please. Well, maybe we want to wait for the hand mic. Thank you so much.
Sorry, you say you are collateralized as a COSI. Is the coupon also collateralized?
Yeah, it is, because the payoff is not calculated by us in the context of the collateral. It's the SIX calculate the price of the product, including the coupon. And on the back of it, it's claiming collateral from us for the notional and for the coupon.
Okay, perfect. And the second question is, what happens when you would default after 1 month?
Then the assets, I think the law is the SIX has 1 month to unwind the collateral that we pledged against the products and to give you the, at the time of the bankruptcy, and to give you the value back of their own monitored value back to you. What I mean by that, it's very important to make the difference between a price computed by us and a price computed or by any bank and the price computed by the SIX. A price monitoring by the SIX means that you have no credit risk component. In 2008, when you most likely have tried to unwind some products, sometimes some banks where the rating is actually going down, then sometimes they say, this is a mark-to-market of our product.
And there will be a break in 1 hour where you can chat on this, okay? Because it's now more than a minute answer.
Yeah, but it's going to be very quickly. My point is, in this case, the difference is because the price is calculated by an independent organism, the valuation is fair and the collateral is equal to that amount. So it's very important to keep that in mind.
But the question was, your value, you gave these 99% or 100% is depending on time, is calculated by the end, by maturity.
Yes, so it is.
So in the first months, you would lose?
No, because it's irrelevant. What the SIX will do, they will take the volatility computed by the market, the interest rate coming from the market, the Eurostoxx level coming from the market. They will disregard the fact that it's
time value. You would lose the
1 month, but that's my point is they will unplug the fact that it's an EFG product. For them, it's irrelevant. They will focus on the payoff and the underlying performance, and that's the only thing that will matter.
You two, you want to have a chat in the break, okay? Agree? Okay. Is there another short question?
And long answer.
Well, now, of course, nobody's motivated to ask a question anymore. Yeah. Well, I think we have to thank Mr. Besnard. Thank you so much, and good luck.
Thank you.
Thank you.